Hello everyone, welcome back to my channel Prep and Pause, the place where we make tricky accounting topics super easy to understand. So if you're new here, my name is Misbah, and in my last video I shared a quick intro to IFRS, why it exists and how it helps businesses stay transparent and fair. So if you have missed it, check it out after this. So, moving forward, today we'll be discussing one of the most important IFRS standard, that is IFRS 15, revenue from contract with customers. So now let's talk about what we are going to cover today. First, a quick look at what revenue really means in accounting. Then, why IFRS even matters, because not getting right amount of revenue can really mess up everything. Next, we'll break down the 5-step model. This is your golden guide for revenue recognition. And I won't leave you hanging. We'll look at real life examples and common scenarios like subscription, discounts, loyalty points, refunds, you name it. And last, I'll show you simple journal entries so you can exactly know how to apply this in real life. Sounds good? Let's go. Okay, so first thing first, what is revenue? So revenue is basically the income a business earns from its main activities, like selling goods, providing services, or both. Simple, right? But here's the catch. When companies make multi-service deals, receive advance payments, or promise extra goodies, it gets tricky to figure out when you should actually record the revenue. So that's where IFRS 15 comes in to save the day. So now let's talk about why IFRS 15 matters so much. First, it brings consistency. Everyone from a small local firm to a big multinational must follow the same clear steps to decide when and how much revenue to record. So no more random timings just to make profits look better. Second, it handles tricky situations like multi-service deals. Many companies don't just sell one product, they bundle goods, service, support, or upgrades together. So without any clear rules, some companies might end up recording all the money upfront, even though they still owe the customer the future services. So IFRS 15 fixes that by breaking the deal into parts and recognizing revenue only when each promise is delivered. Third, the timing matters for tax and compliance too. In many countries, whether it's GST, VAT, or sales tax, recording revenue at the right time keeps your tax filings accurate and helps you avoid penalties or surprise audits. Finally, investors and stakeholders trust the numbers more when revenue is recognized properly. Revenue is the first thing they check. It drives profit, cash flow, and even the share prices. So, getting revenue right under IFRS 15 keeps your books honest, your taxes clean, and your businesses credible no matter where you are in the world. So, as a finance professionals, here is your new best friend, the 5-step model. Step number 1, identify the contract. This is your deal, a written or even verbal agreement. Step 2, identify performance obligation. What promises are you making? A product, a service, or both? Step 3, determine the transaction price, the total money you expect to get. Step number 4, allocate that price. If you have multiple promises, split the money fairly. Step number 5, recognize the revenue only when you deliver what you promised and control passes to the customers. Easy to say, trickier to do. So let's make it real with examples. Alright, now let's see together how this 5-step model works in real life with a quick Dubai style example. So imagine Imar signs a deal in January 2025 to sell an apartment for $1 million. The customer pays 20% upfront and will get the keys in March 2026. So now the question, how do we recognize this revenue step by step? Let's break it down. Step number 1, identify the contract. In our example, customer signs a written agreement with Imar in January 2025 to buy an apartment. That written contract means the deal is legally enforceable, so step 1 is done. Number 2, identify performance obligation. Here, the promise is very clear. Imar promises to deliver one completed apartment. There is only one performance obligation, that is to hand over the apartment as promised. Determine the transaction price. So here the total agreed price is $1 million, no hidden extras or discounts, so the transaction price is simple $1 million. Allocate the transaction price. Because there is only one obligation, the apartment, the entire $1 million is allocated to delivering that apartment. If there were any extras like furniture, parking, or maintenance, we would have split the price among those parts, but here it's just one performance obligation. Now, last step is to recognize revenue when the performance obligation is satisfied. This is the key part. MR cannot recognize that $1 million right away. Why? Because the customer doesn't have control of the apartment yet. It's still under construction. So the 20% upfront payment, that is $200,000, is recorded as a contract liability, advance from customer, not a revenue. The remaining amount is paid when the keys are handed over in March 2026. That's when MR can recognize the full $1 million as revenue because the control has passes to the buyer. So now we look into the journal entry. In January 2025, as MR received 20% upfront payment, that is $200,000, MR will record it as bank debit, contract liability credit. It's a liability, not a revenue, because the control has not been passed to the customer. In March 2026, at handover, the control has been passed to the customer, the keys are with the customer. So now what will MR record? Bank debit, the remaining $800,000, contract liability debit, $200,000, and the whole amount revenue, $1 million, is recorded as revenue because now the control has been passed. And that's it. The full $1 million is now recognized correctly step by step. So before we jump into the next example, I really want you to remember this. The best way to actually understand any IFRS and not just memorize boring theory is to see how it works in real life. So let's switch it up. The next example is software subscription. A company sells a 1-year license for $12,000 paid upfront. So now how the revenue will be recognized? Should you recognize all 12,000 today, or what should be the ideal scenario as per IFRS 15? So here the question is, can the company just pocket that whole 12,000 as revenue on day one? The answer is no, because when you sell a subscription, you are basically making a promise that, hey customer, you will get the access for the whole year, not just today. So if you took the entire 12,000 and recorded as revenue right away, that would be misleading because you still owe the customer 12 months of service. That's why IFRS 15 says, hold on, only recognize revenue when you actually deliver what you promised. So in this case, we spread the 12,000 evenly over the 12 months. That means the company can only count $1,000 as revenue each month once that month's service is provided. Think of it like this. Every month that passes, the company earns that part of the money. The journal entry would be, when the company got paid upfront the entire 12,000, bank will be debit by 12,000, contract liability, that is advance from customer, 12,000 credit. Then every month till 12 months, contract liability debit 1,000, revenue credit 1,000 till 1 year, that is 12 months. So the cash is there, but the revenue only appears bit by bit, matching the actual service period. Simple, fair, and no surprises for anyone looking at the accounts. Let's move forward to the another classic example of a software license company plus technical support. So imagine a company sells a software license for $6,000 and also provides 1 year of tech support for $4,000. The customer pays the full $10,000 upfront. So what is going to be the revenue treatment? Here is the catch. The company cannot record $10,000 as a revenue on day one because under IFRS 15 there are two different promises or two different performance obligations here. Number one is the license. The license is delivered to the customer immediately and the customer gets to use it right away. So the revenue for that part is recognized immediately. But for number two, the technical support, which will be provided over the next 12 months, the support has not been delivered yet. The company still owes the customer 12 months of help. So that part stays as a contract liability until it's earned month by month basis. So here how the journal entry is going to be looking like. On day one, when the company will receive the entire amount of $10,000, the entry is going to be bank debit 10,000, contract liability 4,000 credited, and revenue for license 6,000 credited, because the revenue for license has already been provided to the customer. The control has been passed on, so it is good enough to be classified as revenue. For the contract liability, we still have not given the customer the required help, the required technical support. The 4,000 is going to be the liability. Then each month for a year, the contract liability will be debited and revenue will be credited by 333.33. The company earns the support revenue gradually matching the service actually provided. No overstatement, no surprises, just fair and clear. Let's do a service twist. Consultancy with a discount factor example. There is a firm signs a 3-month contract, consultancy contract for $5,000 per month. But here is the hook. If the client pays the full amount upfront, they get a 10% discount. So instead of $15,000, they paid $13,500 upfront. And the customer has already paid the amount upfront. So how and when the revenue will be recognized? First of all, the full upfront payment is a variable consideration because the final amount depends on whether the discount condition is met. Once paid, it's locked at $13,500. Under IFRS 15, the company can show the whole $13,500 as revenue immediately because they still owe 3 months of service. The initial entry, as we already know, the customer has paid the entire amount upfront for the 3 months consultancy contract. Instead of paying $15,000, he availed the discount of 10% and he paid $13,500. The initial entry is going to be bank debit 13,500, contract liability 13,500 credited because the services has not been provided yet. Each month as work is done, contract liability debit 4,500, revenue credit 4,500. So the discount affects the total, but revenue timing still matches the actual work done. No shortcuts. Alright, now let's look at loyalty points. A really common example, a really common real life situation, especially for retail stores. Say a company sells a laptop for $5,000, but they also give the customer $200 worth of loyalty points that can be used for a future purchase. So here's the trick. Can the company just record all $5,000 as revenue right now? So here is the catch. Company cannot record the full 5,000 as revenue right now because those loyalty points are actually like a mini promise. Like, hey customer, come back later and use this $200 to buy something else. So that $200 is a separate performance obligation. The company still owes the customer the value in the future. So under IFRS 15, you have to split the sale. Part 1, the laptop you delivered. Part 2, the loyalty point which will be used later. So how does that look in the books? When the sale happens, bank debit 5,000, revenue for laptop credit 4,800, contract liability loyalty points credit 200. So you can only recognize 4,800 as revenue right now. The $200 sits as a contract liability until the customer actually redeems those points. Then when the customer comes back and uses the points, contract liability debit 200, revenue credit 200. So the revenue is recognized step by step only when the company delivers the extra value they promised. That's fair to the customer and keeps the accounts clean too. So let's tackle refunds because not every sale is final, right? So imagine Training Institute offers a 10-day course for $10,000. But here is the twist. Students can cancel within first 2 days and get 50% back. The company also expects 10% of the student might actually ask for that refund, So what does that IFRS say? So under IFRS 50, you cannot just record the full $10,000 as revenue right away because you might have to give some of it back. The refund possibility is called variable consideration, meaning the final amount will change. So how do we handle it? Simple, we only record the part of the revenue we actually expect to keep, and we set aside the rest as a refund liability, like a small reserve just in case. So when the customer pays, bank debit 10,000, revenue credit 9,000, that's 90% of the fee you expect to keep. Refund liability credit 1,000, 10% chance of 50% refund. So that $10,000 sit aside in a refund bucket, not revenue yet. So now what happens if a student does cancel within the refund period? You give them their money back. So refund liability debit 1000, bank credit 1000. Easy? No surprise loss because you planned for it. But if no one asks for a refund within the window, so then you get to move the amount from the refund liability to real revenue. Refund liability debit and revenue credit by 1000. Now let's talk about principal versus agent, and let's make this fun because this one always confuses people. So picture this, that you're hungry, you open Talabat or Uber Eats or Noon, Food Panda or anything that's available in your country, and you ordered a burger from a Burger King for $50. Now my question, who actually owns that burger before it hits your doorstep? Talabat? No, obviously not. It's Burger King. So in this story, the Burger King is the principal that makes the burger, they control it. Talabat is just the agent, the messenger who connects you to the food. So when the customer pays $50, does Talabat get to show the whole $50 as revenue in their books? No. Talabat only earns the commission for arranging the deal, say 10%, so $5. The rest belongs to the Burger King. This stops the agent from pretending they own the stuff they never really control. So let's look into the journal entry. There is an agent who collects $5,000 from someone and has to keep the commission of 10%. Let's assume the agent is Talabat. Talabat collects $5,000 from a customer and has to keep the commission of 10%. So the entry would be bank debit 5,000, payable to the vendor. Let's assume the vendor is Burger King. 4,500, revenue credit, that is 10% of the total amount is 500. So Talabat true revenue is just their cut, not the full order price. So a quick tip, always ask, did the company really control the good or service before giving it to the customer? If yes, they are principal. If no, they are just an agent and only record the fee they keep. So next time you order food online, you will know exactly who is making the money and who is just delivering it. Pretty cool, right? So that's it for today's video. I hope this helped you understand IFRS 15 and how to apply it in real life. If you found this useful, please like, subscribe to my channel, and don't forget to comment down below if you have any questions or if there is any topic you would like me to explain next. I would love to share more practical, simple, and real-world accounting videos, so stay tuned. There is a lot more coming your way. So thank you so much for watching. See you in the next video.